This is Robert Kraft, and I'm your host on SNN.Network. And with me today for this Wall Street View, I have Christian Ryther from Curreen Capital. Christian, welcome back. Good to see you.
Thanks, you too. It's a pleasure to be here.
It's great to have you on. So the reason that I invited you on today is that Curreen Capital just published their Q2 2019 letter. So I wanted to just talk about it a little bit more, get some more color on what's gone on in the last quarter as well as the first half of 2019. So to start, let's start with your fund investment philosophy briefly. What is the fund strategy?
We copy sort of Buffett, Munger, Greenblatt, so we're looking for good business, good management, good price. Like it has to fit all of those, so it can't just be a good business with a good management that has a sky-high price, but it also can't be just like super cheap, mediocre business. So we want all three of those parts, and since that's hard to find, we try to look at weird situations like spinoffs, companies buying back their own shares, preferably with some sort of tender offer, some weird thing there, or turnarounds. Those are areas that give us a better chance to find those good business, good management, good price combinations.
Got it. So then now time to review the first half of 2019. How did the fund perform overall for this period and why?
Did fairly well. I don't even have the numbers in front of me. It's up 20-something%. Part of that is that we had such a painful 2018 and a lot of stuff has bounced, especially early in the year. So I think that was the main part. We own good businesses that run well and they were cheap. They were especially cheap at the beginning of the year. They're a little bit less cheap now. I don't know why the market does what it does. I'm happy that we've had this, tailwind at our backs. Mm-hmm. I'd like it to continue, but that's what you always want. Yeah.
Yeah, I was gonna say it speaks to staying in a position, having that longevity, right? Because then it helps curtail any sort of risk where any sort of market risk where even if there's a little bit of bad news, it might not be thesis changing, right?
Yes, and we've had two companies report this month in July. Both I thought were not great, but not so bad, and the stocks have both been hit hard. And I'm like, I don't think everybody's looking at this the way that I am, but that's the market, and that's what creates opportunities. So you can't. I don't cry there's no crying in baseball, is what I try to remember at times like this. Like you just play your game, and it works out eventually. Yep.
And also I think in investing, you got. Look, in baseball, you go 3 for 10, you can make $10-20 million a year. In investing, you go 1 for 10 and make 10 to 100 times that.
Yeah, if it's the right one. Yeah,
that's right. So then also in the Q2 letter, you discuss at length why you bought shares in this one company. Can you explain your thesis here and then how that fits into your overall investing thesis?
Yes, we bought shares in Contour, and I like in the letters to talk about what we've done. I try not to talk too much about what I'm thinking. I just want to give people here's what I actually did, because that's the culmination of all of the thinking. So we bought Contour, which is a spinoff from VF Corp, and Contour is a pretty boring business. They make Wrangler and Lee jeans, which are probably the least sexy jeans out there. You can find them at Walmart. They sell for less than $20. It's like $19.93 or something like that at all the Walmarts I've been to. But we like it because it fits our strategy. It's a good business with returns on capital above 20%, even when you adjust for the fact that they sell some of their receivables, because Walmart is a big customer and Walmart doesn't pay very fast. But even if you adjust for that, you're still getting above 20% returns on capital after tax, which is, for me, a good business. I think that that's sustainable. They've been able to do it in the past. I think they're able to continue to do it because, Wrangler and Lee are jeans that are in demand. They sell to people because it's a good price point and it's a good quality. I like the management. Scott Baxter is the CEO. He used to run the jeans business for VF for a few years. The performance operationally during that time was great. He got promoted, so then he was running the West division of VF, which is the hot stuff, which is like Vans and North Face, which have been doing phenomenally for VF for a while. So he's run this business before. He ran it well. He got promoted to do something cooler, and now he's chosen to come back. All of his VF stock options have converted into Contour stock options, which I really like. So good management, good business, and the price the price got really darn cheap. Like this year's earnings are going to be down because of all sorts of spin-off weird things and because they've been having trouble with Lee, and it's still selling at about 10 times earnings. Most of that is going to come back to you as a dividend. So like where we bought it, a bit below 29, we're getting an 8% dividend yield. It's not super sexy. It's not exciting, but it's a good business, good management, good price. And I think I can deploy the dividends somewhere else. And if the stock price goes up, then maybe we move on to something else. And until then, we're happy to be in a good business with a good management at a good price. Yeah.
Gotcha. So, for some people, they might think, okay, they're in Q2, you might have just happened to find this company, but when did this company come on the radar as something that you were tracking, and then ultimately you're like, all right, if it gets to here, then we might go in and start positioning ourselves into the stock?
I think it was in the fall when I first saw that VF was talking about spinning off their jeans company, and then right after that, I think Levi's started talking about, hey, we're going to IPO, and it was just like, get out of the way, Levi's is here. Like it was just like jeans season, and Levi's is obviously the cooler, better company and a much higher price. So that's when I first saw it. And it got on my radar, and I have a piece of paper, like a little notepad, where I keep track of all the things that I think might be interesting to work on. And so that's when I first put it down. I don't remember when I first read their SEC filing, the Form 10, the original one, probably a few months after that. That's when I started to read about it. And my first test is like, is this a good business? Because I can calculate that in a few minutes. And I was like, wow, it's actually a good business. Like, kind of boring. But good enough to keep looking and not just like toss it aside and move on to the next thing on the list. So yeah, it's initially in the fall, probably a lot more February, March, April coming in as I got more information. And then I finally had the price, and when it started trading on the when issued market, then I got really disappointed because the price was way too high, but that managed to come down to me. Yeah.
Fair enough. I mean, because my main point is that I want to come across is that it's not always a flash in the pan. That quarter you found the idea, you positioned it to. These things are more often than not, they take time to do the work, and then now we're taking the position and we're deploying capital into it. So that's what I wanted to get across. And
for me, like, I can find a good business, and if I like the management, then I've got 2 out of the 3 that I look for. But then the price doesn't necessarily get where I need to be for a while. And sometimes it just keeps going up, and that's incredibly painful. But sometimes it does come back down, and then you've got this watch list of things, and it's like, wow, I've got like 5 interesting things. Like, that's a fun problem to try to solve. Like, where do I put all my money? Yeah.
Well, I mean, does the fund? I mean, obviously it depends quarter to quarter and year over year. Is there a sweet spot as to how many names you like to enter into or have in the portfolio at any given time, or how do you construct a portfolio like that?
We've been probably in the 6 to 8 range for a while, for like 2-3 years or something like that, and that suits me. I like to go in pretty deep and understand like all the stuff as much as I can. And the more companies I'm looking at, the less, crisp I am on each of those ideas. So usually I've done work on a company, something happens, either big news that's relevant to the quality of the business, or big news about the management, or the price changes a lot, and then I have to, revisit and go back. But I get like an alert or something, or I read a news article or something about that. But yeah, it's tough to know where to put your time, because you can do a lot of work on a really cool company, and then the price is like IAA, which spun out a car. Like, I really like that business, but I don't like that price, and it's like, I did a lot of work, and now I'm just going to watch it go higher.
Yeah. Well, actually, it's funny you say that, because that pertains to my next question. That I'm surprised I've never actually asked anybody this when it comes to small microcap stocks. Is there almost a feeling that, yeah, you want to move quickly if you feel like, okay, it's got a couple of the metrics, but at the same time, you're like, small microcaps, I think I might even be able to chill out a bit on, I can take my time. There's not a huge rush where I need a week. Like, okay, I'm just focusing on Contour right now. Like, don't nobody bother me. Like you kind of have a little bit of time. You're like, all right, I can spend my time researching it, doing it. I'm comfortable that the price won't have too much swings one way or the other, that I can do my due diligence and then ultimately get in at the price point I want.
I see that, and I feel that. I do like, well, with spin-offs, I like the spin-offs a lot, because then there's like a day,
Right.
like that the spin happens, and around there can be like crazy stuff that happens that moves the price a lot. And I can't necessarily predict that, but if I have a specific price in mind, then I can take advantage of it. So those are helpful, because like if I could always do it tomorrow, then sometimes I just never get to it, because I'm always like, well, I'll just put out this fire over here and this fire. So for me, that's helpful to have like a day. It's different with like turnarounds or with, tender offer companies, because there it's like you find an opportunity and you're like,
I gotta go.
Yeah. And it's tough to know. Like I when I write in my investment journal, I'm often like, well, the stock's been falling. I like it here. I would like it even more cheaper, but like all I've got is the price in front of me. Like I can't predict tomorrow. And usually it's going to be cheaper tomorrow if it's been getting cheaper until it's not. And then, that's a hard thing to manage.
So actually, what you mentioned as a reason for why you love spinoffs, just in your answer just a second ago, and then in the letter itself, you also say how much you love spinoffs like Contour. So what, as a whole, what other than just it helps with timing, what are some of the other reasons why you love spinoffs?
I mean, the base rate is good. Like all the Joel Greenblatt stuff is still true, that like it's a fundamentally inefficient way to get shares out to the market. Like you're giving people stock that they didn't want and don't really have much interest in, and financially it's usually not a big deal. Like Garrett Motion, which we own, spun out of Honeywell back October 1st. And if you had $100 of Honeywell, you now had $1 of Garrett. It was just like insignificant for people. So all that, like fundamentally, I think it's still a good place to fish. It's a good place to look for stocks, because it is fundamentally inefficient, and that can create opportunities for you as a buyer. But for me, like the spinoffs I like most are these sort of ugly duckling spinoffs, where like Top Build, which we also own, was spun out of Masco. And Masco's CEO was like, well, this is like a low margin business. It's not a branded good, like all our magical faucets and cabinets and all that stuff. And he's just talking down this company. It's like, oh, it's just low margin junk, essentially. And you look at the business, it's like, yeah, it's low margin, but they've got fast turns and no working capital. Like Walmart is a low margin business. Amazon is a low margin business. Like that is not at all incompatible with being a great business. But thank you for like telling everybody it sucks, because now I have a chance to buy it. Like, so I like those. I mean, I'm calling them ugly ducklings lately, where it's just like everybody's like, this is a terrible looking duck, and I'm like, it's a beautiful swan, and like that lights me up when powerful people are telling one story, and it's like, well, it's actually great, guys, but if you want to give it to me cheap, I'll take it. Yeah.
Christian, I'll go in on this with you. Let's co-brand the ugly duckling screen.
Yeah,
I think that would be huge.
It's a good name. Like, yeah, it's worked for a couple hundred years. Like, kids love it. Yeah.
Oh, I love that. So then another thing in your investment letter that you mentioned is that your investment strategy allows you to, and I quote here, cut through uncertainty and fear about what the future will bring. And this really specifically pertains to how the market and economy will perform. So how does your investment strategy allow you to do this?
So I read the paper like everybody else. I get freaked out about everything all the time.
You still read the paper?
I do. Yeah, it's part of my process.
Come on, you got the phone, man.
You find these weird articles on like a random page just because it's open. Like I'm looking at this article, but then there's this other weird thing over here. Like I don't know. Plus, I don't want to have my phone with me while I'm eating breakfast. And yeah.
Fair enough.
But I don't even know where I was going. So how do I cut through it? I mean, this happened because I get worried about the market, like the inverted yield curve. That like, I remember I read about that in 2000, and then in 2006 it inverted again, and I was like, it doesn't matter. And then everything fell apart 2 years later. And so now I'm like, I should probably pay attention to this inverted yield curve. So I look back in my investment journal, like, okay, have there been times when the stock market fell apart, and like, did I totally screw myself by buying something right before that? And I looked back and it's like, actually, no. Like, I was just as worried back in late 2015. I was just as worried back in like fall of last year. But I bought, Credit Acceptance the first time, and I bought Micro Focus the second time, despite my worries, because these businesses fit my 3 key criteria, and they worked out great. So it's like, so as much as I freak out about, in particular, the inverted yield curve, and then you can find all the other bad things that you want, which have been there for a while, but now the inverted yield curve is new. But when I've been worried in the past, as long as I just like stick to what I can do, it still works out for me. So for me, that was like, chill out, Christian. Yes, you're terrified. Maybe rightly so, maybe not. Who knows? But that's not what I'm good at. Like, I'm not some sort of magical super economist who can figure this stuff out. But I can figure out a good business with a good management at a good price, and that has been enough, which is like the key for me. So I wrote that in part because I think it helps me, and also to like remind myself, like, chill out, like, do what you can do. Like, it might be the case that like, hopefully prices go up enough that I'm forced to sell, and then if I can't find anything good, then I have cash. Like, that would be the dream if there is some sort of bad thing. But like, it's better for me to focus on the 3 things that I can do, the 3 key criteria, than to focus on something that I have no demonstrated expertise in at all. So that's
the flow through is good business. No matter what's going on in the market and the economy. That's what I get from gentlemen like yourselves and other fund managers, is that as long as it's a good business, that at the very least, even if it goes down a little bit when the market starts to tank, you feel confident. I know it's a good business.
Yeah, I'm not going to get totally crushed if there's a recession. Like, I've got a good business that can handle, the crazy world we live in. Plus, I've got people that I trust running it who aren't going to take advantage of that by totally screwing me over. And they're going to take advantage of whatever dislocations there are in the market. And if I bought it at a good enough price, like, it gives me comfort to handle whatever, rainy days that are coming.
Right. So then, look, even though you don't concern yourself so much with it, that this doesn't stop you from commenting on it in the in the letter itself. And by commenting on it, I mean the market and economy at large. So, what is your take on what happened in the first half of 2019? And are there any trends or catalysts that you see that you're looking at for the rest of 2019? A loaded question.
Yeah. I'm nervous. So despite like saying I'm going to follow my 3 key criteria, I'm still nervous. The inverted yield curve, I think, is a big deal. I think it just stopped being inverted like 2 days ago, but nevertheless it was, and I don't understand what that means, but historically it's been a bad sign. I've also been reading these crazy Austrian economists, which is probably a terrible idea for me. But one of their ideas is that the consumer is the last person to feel the effects of a coming recession. So whenever I read things in the paper or on the internet about how the consumer is really strong, I'm like, yeah, but that's irrelevant. Like, that's the end of the tale. That's not the beginning of the problem. The beginning of the problem is stuff like the railways and stuff like that with, like, I don't know.
It's hard to ignore the contrarian argument, especially when the market has just continued to be so frothy.
Yeah.
It's hard.
It's all-time highs, and maybe we get something like 2000, where after 2000, like, these internet darlings blew up, and all the hedge fund people looked like geniuses because they own good businesses, and so the world can fall apart and maybe your stocks can still do okay. Because who knows? I certainly don't know. What I do know is that I can do my good business, good management, good price. And when I look at the world, I'm like, this is toppy. But what does that mean? Like, I'm just some guy. So yeah.
Right. No, you're gonna keep reading the news, keep following along, see, and really.
And I put it into my but I own a housing. I own a housing start company, which is Top Build. Like, their entire business is housing starts in the United States. And I also own a auto supplier, which is like China matters, Europe matters a lot. It's like, so here I am totally worried about the economy, but nevertheless, the companies that are coming through my filter as good businesses with good management at really good prices are like these very economically sensitive things. I got to follow what has worked for me historically and that makes sense to me, in spite of my fears.
So, Christian, with that, where can my audience go and find more information about you and Curreen Capital?
Come to the website. It's CurreenCapital.com. That's CURREEN and then capital. We've got some videos there. We've got some letters there. Come check it out.
And where can my audience follow you on Twitter?
Yes. You can look for my name, Christian Ryther, or at CurreenCR, CURREENCR. That's me. And
thank you so much for joining me today, and look forward to speaking with you soon.
Thanks. It's been a pleasure. Bye-bye.